Hey traders, Jason here from Leavitt Brothers. Happy Monday, happy August. I've been on the road the last 6 weeks, hence my radio silence. I of course have had internet everywhere I went, although it wasn't always good, but I just didn't have the bandwidth to do videos and such. Here's a screenshot of where I was, starting in Denver, stopping Steamboat up into Wyoming, stopping Jackson. We're in the Tetons. Went up to Yellowstone, way up into northern Montana, Glacier National Park. Then we took the northern route across the country to Chicago, which we were for a couple weeks, and then back to Denver. So I'm back in Denver now and intend to ramp up my videos and blog posts. We're on the road for 6 weeks, but now I'm back. Kids go back to school. Everything routine-wise should fall back into place. Okay, so since my last video at the end of June, the market essentially grinded up into the end of July. That fell hard for a week. It bounced and recaptured like about half the loss, and now it's heading south again. In this video, I'm going to get everyone up to speed with what I see out there. Okay, I'll cover a couple of the index charts, and then I'll look at the breadth indicators to see where they stand. All right. So first, S&P 500. Overall, it's trending up. If I were to zoom this out a couple of years, it would be trending up. But as you can see here, we have like a marginal new high that immediately got sold into. We have another marginal new high over here that got sold into. So the trend is up, but every time the S&P makes a new high, it fails, which is fine. It doesn't have to pause at a previous high, consolidate, and then break out and rally hard. It could stair step forward. It could go 4 or 5 weeks up and then a week or two down. I mean, that's perfectly fine. And the shorter term, what I'm looking at is the orange line here, which is the 21 EMA. You can see that it was nice support here, and then it was resistance there, and then it was support, and now it's resistance. So that's kind of my line in the sand. So until that moving average can get taken out and held, I'm going to have a downside bias. Okay, this is what I see right now. If I look, at the recent action, you see, low here, high here, price action is like right here, so it's in the bottom half. So we're below the moving averages. We're in the bottom half of the range. My bias is going to be to the downside, but it's not drastic. It's not like the market's getting crushed or anything. Just in the near term, if you're a long-only trader, you got to be a little bit more careful with what's going on. I certainly wouldn't be too aggressive going long unless it's in select groups that happen to be doing very well. All right, here's the Russell 2000. This is one of the issues. This is the S&P made an all-time high, and the Russell did a higher high, but then immediately sold off. And over here, the S&P made a higher high, a new all-time high, and the Russell put in a lower high. What I see here is just a big fat consolidation range. Okay, I mean, prices are literally unchanged going back like 10 months. Right now, you could maybe argue that the price action is getting compressed by here, but I'm not even going to bother with that. I just look at this and say the entire Russell has been trading in a range for like 10 months, and any move up with the S&P that does not get accompanied by the Russell coming along for the ride is just simply not going to last. Okay, small caps don't have to lead. Okay, in fact, they typically don't lead, but they can't lag by too much. Okay, so if the S&P tries to run up again, the small caps have to do the same thing. Okay, if they don't, then the S&P is going to be held in check. The reason why this is such a big deal, this chart compares the small caps to big caps. So let me point a few things out here. Okay, so the top pane here is the small caps versus big caps. The bottom pane is the S&P 500. So you can see here, small caps underperform big caps, and then the market tops a couple months later. Okay, small caps underperform big caps, and then the market tops a couple months later. Small caps underperform big caps, and then the market tops a couple months later. Okay, so small caps can underperform the big caps for a little while, and the market can continue to press higher, but eventually that negative divergence weighs on the market. Okay, the divergence is still in place. The small caps are still underperforming by a pretty good margin, and of course we got a top recently. So what I'm looking for going forward is some sort of outperformance or at least firming by the small caps. Okay, so you can see here where the small caps did well and the market did well, and the small caps did well here, and the market did well here. So that's what I'll be looking for. We're going to need, if any move up is going to sustain itself, we're going to need this chart, which is the Russell, I think it's Russell 3000 versus, or it's Russell 2000 versus the Russell 1000. We're going to need this curve to start slanting up to confirm that the small caps are not being left behind. All right, now let's look at some breadth indicators. I have a lot of charts here. Some of them I'll talk about in detail. Some of them I'll just kind of zip through because they're a little bit redundant. Okay, so we have here is the SP 500. The middle pane here is the 10-day moving average of the AD line, the NYSE AD line. To get everyone up to speed, if you're not familiar with my work, when the market trends up, you get steady prints of the 10-day moving average. Mostly above zero, but there are dips below zero. Okay, this is normal action. This is perfect action. If you want the market to steadily trend up, you want this to basically oscillate up and down, mostly above zero, with a few dips below zero. And when you get that, you get the market steadily moving up. Okay, when you get a dip below, which is what happened here, then you get a bigger move down. Okay, let me back out some of these so we could... Okay, so another thing I look for is a divergence, a divergence at a lower level. So here we have the market pressing higher, an obvious lower high from the indicator. That signals the top is probably forming. Okay, then you have indicator gets trapped under zero, and what happens is you get a bigger move down. Okay, if I compare that to, let's say here, this divergence took place at a higher level, so it was much less potent. Okay, and then you can see here the dip went down to zero, and then it quickly recovered, and so did the market. So if you compare these two instances where this this divergence took place at a lower level, whereas this one took place at a higher level, and then over here where the indicator got trapped under zero, whereas over here it only briefly went below zero and then recovered. That's why over here we got a bigger move down, but over here we got a resumption of the trend. Okay, so what I'm looking for right now is we got a divergence here, as you can see. Okay, this is something I pointed out at Leavitt Brothers, so I warned all of our subscribers that the divergence was forming. It was forming at a lower level. You can see here down near zero that a top, not necessarily a top, but we need to be really careful with going long, initiating new longs, and be careful with have appropriate stops in place. Okay, so now the indicator's down here below zero. So if it gets trapped below zero here, which is kind of what had happened over here and what happened over here, whoops, didn't draw that one right, it's all right. So if it gets trapped down here below zero, we're going to have, the market's going to do one of these. It's going to fall again. Whoops, that's not what I want. The market's going to fall, the market's going to leg down again like this. But if this indicator can get back above zero and do this, then we'll just have a moderate move down and then a recovery. Okay, so this indicator will tell us how healthy the market is. If it stays below zero, we're in trouble. If it gets back above zero and can hold that level, then the market will be just fine. Okay, right now I lean down because it's below zero. Okay, here's the same chart with the NASDAQ. Okay, the last chart was the NYSE. This is the NASDAQ. I'm not going to go through it in detail, but it's pretty much the same thing. When the indicator gets trapped under zero, okay, you get a bigger move down, okay, which is what we're going to get over here. But when you get, here we got a move below zero, but then a quick recovery, and then the market recovered, okay? So we're looking for this, okay? If the market decides to go up here, and this thing kind of comes up and struggles, then we're not going to go very high. All right. Here is the SP 500 up top. The down below is the percentage of S&P stocks above their 20-day moving average. Okay, as you can see, divergences tend to play out at tops. We have the market moving up, less stocks. Okay, at first it just signals like a little bit of a pause in the uptrend. Okay, as you can see here, we have a divergence here, and then the market just simply dips. This was like a 60 or 70 point dip. This one took place at a high level, but notice what happened. The indicator dropped below 50%. It struggled over here, and then it continued further down, which led to a bigger pullback. Over here, we got the divergence, which leads to like a relatively minor move down. But then when the indicator got trapped under 50% here, we got a bigger move down. Okay, so what I'm looking for right now is, can this indicator recover? Okay, right now it's below 50%. We got a negative divergence, which I warned our subscribers about. Now we've gotten a stiff move down. If this indicator can recover, then the market will be fine. Maybe it'll bounce around a little bit, but eventually it'll resume its uptrend. But if it struggles down here, if it stays down here and does one of these things, the market's going to head south again. Okay, so any move up that does not get accompanied by this indicator also moving up is going to spell trouble for the market. All right, same indicator except we use the 50-day instead of the 20. It's very similar. I use it as like a back, as a way to back up and see the bigger picture. But the indications are essentially the same, so I'm not going to go into them too much. When the indicator gets trapped down here, you get a bigger move down, which is exactly what is happening here. Okay. If the market's healthy, it'll get above, in this case, 55%, and then the market will be fine. So this is what I'm looking for. If the market attempts to rally, this thing needs to get above 55% and hold that level. Continuing on, here's S&P 500 versus the new highs at the NYSE. When the market trends up, when it's healthy, when it's doing this, you get steady prints at a pretty decent level. Not too high, because that usually signals a blow off top. Not too low, because that signals weakness. You get steady prints in a range. Okay? And that's exactly what we have right now. So far, so good. The bigger picture looks fine. Some of the shorter term indicators that I just talked about are not doing as well. But as far as the bigger picture, this looks pretty good to me. Here's the S&P 500 versus the NYSE high-low differential. Similar situation. When the market trends up, you get steady prints around zero, which is what we've been getting. Okay, and then when the market turns weaker, as you can see here, you get the indicator gets trapped under zero. So what I'm looking for going forward is that if this thing falls and fails to get above zero and kind of hangs out down here, market's going to be in trouble. But if it can get above zero and stay there, we'll be in good shape. Okay, right now it's kind of neutral. It's at zero, putting in a lower high. It can go either way here. The bulls have work to do. All right, so here's the Nasdaq new highs. Similar as the Nasdaq, so I'm not going to go into too much detail. When the market trends up, you get steady prints at a decent level, not too high, not too low. Right now, it's down near the bottom of its range. It's salvageable, but there's very little room for error here. Okay, if this thing breaks down like this, but then fails to move up, the market's going to be in trouble. Okay, it's not going to go anywhere. It's going to go down, actually. It's not going to just not go anywhere. Okay, same chart as, this is the Nasdaq high-low, same thing. When the market trends up, you get steady prints above and below zero. It's when the indicator gets trapped under zero that you get a bigger move down. So far, it's okay, but we need some improvement here. All right, a couple more charts. I know this is a small chart. I can't make it bigger without distorting it. This is the S&P 500 in black versus the percentage of S&P stocks at a 10-day high. Okay, so I just looked at the 52-week highs. This is a 10-day high. So forget about what happened 6 months ago, 9 months ago. How about where price is relative to just the last 2 weeks? When you get a divergence like this at a high level, the market tends to move down a little bit, but as long as there's not too much damage done, it resumes its trend. Okay, so that divergence led to just a little bit of a dip. I think that was like 50, 60 points, maybe 70. And then the uptrend resumed. Here was a divergence that took place at a lower level, and then you could see that it actually fell to a pretty low level. Okay, so that led to a much bigger drop. So currently we have a similar situation where we have a big divergence at a much lower level. So the current situation looks much more like April, May, than it does the beginning of the year. Okay, so if the market tries to run up here, okay, if it firms here and tries to go up, we need immediate improvement from this indicator, and we need prints above the mean. If you get an occasional move down, that's fine. But as long as you get most of your prints above the mean, you're in good shape. But if this moves up and then gets rejected and comes back down, the market's going to do the same thing. Okay. Okay, last chart. Okay, similar thing, except instead of using the 10-day highs, I'm looking at 20-day highs. So instead of looking at 2-week highs, I'm basically looking at 1 month. Similar concept. When divergences take place at a high level, they tend to lead to near-term dips, but as long as damage isn't done, the market tends to do fine. But when you get a big divergence and a print at a low level, that's when the market runs into some trouble. You can see here, inability to bounce much led to a bigger and more sustained move down. Same thing here. We got low prints. Low prints led to a bigger move down here, and then even when the market bounced here and here, we got bounces here, but then immediately it went back down. We got a bounce here and immediately went back down. Okay, but if you compare that to here, where we went down, came back up, higher low, and then recovered, the market recovered too. Okay, so what I'm looking for here is we got the big divergence. Okay, so if this can move up and sustain itself at a higher level, the market should be fine. But if we, have one of these things where it, comes up and does a double dip, or it requires it needs to do a double dip before rallying, that's going to spell bad news for the bulls. If we get, let me delete this. So if we get a move up, and everyone's starting to get excited that, hey, that's a nice move up. But if the indicator comes back down, then that too would be bad. Okay, so down here, you got to have a bearish bias. How this thing recovers is going to tell us how well the market's going to do going forward. Okay, if it recovers well, market will be fine. If it can't recover, it's not going to be fine. Okay, so the S&P moved to an all-time high, but the small caps put in a lower high, and several breadth indicators failed to confirm the rally attempt. Okay, after a stiff drop, the market bounced, but the indicators have become somewhat mixed. Some have held up while others have sat at low levels. Okay, the indicators will tell us what's in the pipeline, or they'll quickly confirm or deny what the market is attempting to do. Right now, I lean down. Okay, unless some of these indicators profiled, unless the indicators here that I profiled here can quickly right themselves, we're gonna at least get a second leg down. Okay, thanks for listening. If you like the video and want me to do more, give it a like, share it with your trading friends. You can also subscribe to the channel right here at YouTube and be alerted of new content, which I'm going to start posting more often. Come check us out at Leavitt Brothers. We're a boutique research firm that's been in business for 19 years, 17 years, something like that. I lose track because we've been in business a long time. We provide market analysis, trading ideas to institutional and individual traders. Again, thanks for listening, and I'll see you next time.